Something historic is happening in the commodity markets. For the first time in nearly 50 years, silver is more expensive than oil. We're not talking about a small difference. We're talking about a complete inversion of a relationship that has remained stable for decades. Right now, you need less than 1 ounce of silver to buy a barrel of oil. This has never happened before, and financial market analysts are issuing a warning. Either silver is in a speculative bubble, or oil is being completely ignored by investors. Let's understand what's behind this unprecedented phenomenon.
To understand the gravity of this situation, we first need to comprehend how this relationship between silver and oil works. Since 1975, analysts have been tracking how many ounces of silver are needed to buy a barrel of oil. The historical average is clear: 3.8 ounces of silver for 1 barrel of oil, a ratio of 3.8 to 1. This proportion makes sense because both silver and oil are commodities strongly tied to economic activity. When the economy grows, demand for both increases. During recessions, both tend to fall. But now, the ratio has plummeted to 0.8 to 1. This means you need less than 1 ounce of silver to buy an entire barrel of oil. Nicholas Colas, co-founder of DataTrek Research, was direct. We are in uncharted territory. Silver looks very expensive relative to oil.
Let's look at the concrete numbers that are frightening the market. Silver is trading around $76 per ounce. WTI oil, approximately $58 per barrel. Do the math with me. 58 divided by 76 gives 0.76. You need 3/4 of an ounce of silver to buy a barrel of oil. This is absolutely abnormal. And there's more. The iShares Silver Trust, the main ETF that tracks physical silver prices, has accumulated a brutal appreciation of 162% for the year. That's right, silver more than doubled in value in 2024. Meanwhile, oil remains relatively stagnant, facing demand pressures and excess supply in the global market. This extreme divergence between two assets that historically moved together is raising red flags all over Wall Street. You might be wondering, why on earth are we comparing silver with oil? The answer lies in the fundamental nature of these commodities. Unlike gold, which is primarily a protection asset and store of value, silver is an industrial commodity. Approximately 60% of all mined silver goes to industrial uses: solar panels, electronics, circuits, batteries, medical applications. And here's a crucial fact: only 15 to 20% of silver is recycled. This means most of it is literally consumed, just like oil. The other 40% of silver goes to what we call non-consumptive uses: jewelry, coins, physical bars, and ETFs that allow investors to have exposure to the metal without physically storing it. Oil, in turn, is almost entirely consumed, except when transformed into plastics and lubricants. Both are priced in dollars. Both respond to the same economic cycles. And according to Colas, there aren't many macroeconomic factors capable of explaining the current disconnect between them. That's why this comparison isn't just valid, it's revealing. Faced with this unprecedented scenario, analysts point to two possible interpretations, and both are concerning. First possibility: silver is in a speculative bubble. Nicholas Colas observes that silver has a habit of becoming an extremely sought-after asset every 10 or 20 years, and we're witnessing exactly that moment now. When too much speculative money flows into a relatively small asset like silver, prices can skyrocket irrationally. Investors buy because it's rising, and it rises because they're buying, a classic feedback cycle of bubbles. Extreme volatility reinforces this thesis. On a recent Monday, the silver ETF plummeted 7.2% in a single day. The following Tuesday, it rose more than 4%. These violent swings are typical of overheated speculative markets. Second possibility, oil is excessively despised. Maybe silver isn't too expensive, maybe oil is too cheap. With the energy transition, electric vehicles, and geopolitical uncertainties, investors might be underestimating oil's future value. If global demand recovers stronger than expected, or if there are supply shocks, oil could be trading at bargain prices. The truth? There's probably a bit of both situations happening simultaneously. Nicholas Colas's message to investors is direct and unambiguous. Silver is not a sound long-term investment at current prices. This doesn't necessarily mean silver will crash tomorrow. Bubbles can continue inflating for much longer than seems rational. But the history of financial markets shows that when historical relationships are violated so extremely, painful corrections usually follow. For short-term traders, Colas suggests keep smaller positions to take advantage of short-term volatility. In other words, if you're going to speculate with silver, do it with money you can afford to lose because the swings can be brutal. For long-term investors focused on capital preservation, the moment calls for caution. Entering an asset after a 162% appreciation in a year is rarely a good strategy. And there's another important factor. When traditional assets like stocks and bonds are available, paying record prices for a volatile commodity might not make sense for most conservative portfolios. To complete the picture, we need to consider the macroeconomic factors that might be influencing this disconnect. The US dollar, the currency in which both commodities are priced, has shown fluctuations that affect appetite for dollar-denominated assets. When the dollar is strong, commodities tend to become more expensive for international buyers. The global energy transition is creating growing structural demand for silver, especially for solar panels, where silver is an essential component. Each solar panel uses about 20 grams of silver. Meanwhile, oil faces uncertainties. Electric vehicles are growing, energy efficiency is improving, and climate policies are pressuring fossil fuel consumption. But there's a paradox here. The global economy still depends massively on oil. Aviation, maritime transport, petrochemicals, these sectors have no viable short-term substitutes. This tension between the energy transition narrative and the reality of current dependence may be creating a distorted perception of relative value between these two fundamental commodities. So, what can we conclude from this unprecedented situation? First, we're witnessing a historic moment in commodity markets. The relationship between silver and oil isn't just breaking records, it's in completely uncharted territory. Second, when a 50-year relationship is violated so drastically, the market is signaling that something fundamental has changed, or is about to correct itself violently. Third, investors need to distinguish between real opportunities and speculative excess. A 162% appreciation in 1 year is extraordinary, but it's also a red warning signal. The big question that remains, will this disconnect resolve through silver falling back to historical levels, oil finally recovering, or a combination of both? Market history suggests that fundamental long-term relationships eventually reassert themselves. The question isn't if there will be a readjustment, but when and how it will happen. Nicholas Colas sums it up well. We're in uncharted territory, and in uncharted territories, prudence is always the best advisor. For investors, the message is clear. Don't confuse a bull market with genius. Evaluate risks, size positions appropriately, And remember that what goes up fast can fall even faster.